So we will begin today's keynote with Keith Noreika, who is the acting comptroller of the currency, and we are just absolutely delighted to have him here today over at the Institute of International Economic Law to talk about a topic that I know is of enormous interest to all of us today, the FinTech Charter program, and obviously the larger regulatory activities of the OCC. The IIEL was very, very fortunate to host Mr. Curry here when he had articulated a vision of the FinTech program and the FinTech Charter program, and since then we here have been in very close cooperation and in many conversations, frankly, with the OCC here at Georgetown. So again, it's just a pleasure to continue that relationship. The Comptroller of the Currency is administrator of the federal banking system and the head of the Office of the Comptroller of the Currency. The OCC supervises more than 1,400 national banks and federal savings associations and about 50 federal branches and agencies of foreign banks in the United States. These institutions comprise nearly two-thirds of the assets of the commercial banking system. The Comptroller is also a director of the FDIC and a member of the Financial Stability Oversight Council. Mr. Noreika became the acting comptroller of the currency on May 5th, 2017, and prior to that, he served as a partner in Simpson, Thacher, and Bartlett, this little startup law firm in New York, and a member of the firm's financial institutions practice, where he focused on banking regulation and related litigation. He advised a wide range of domestic and international financial institutions on regulatory issues relating to M&A, minority investments, capital issuances, structuring and compliance activities, and litigation matters, particularly in the area of federal preemption. Mr. Noreika's experience includes advising regional, multinational, and other banks in structuring of their operations, including compliance with the Volcker Rule and Bank Secrecy Act and anti-money laundering rules. He's represented many, many banks before the U.S. Supreme Court, a little court down the street, U.S. Court of Appeals, and the U.S. District Courts. He has also advised and taught students at the University of Pennsylvania Law School and the University of Virginia Law School. And he received his JD from Harvard, where he was an editor of the Law Review. We are just very pleased to have him here today to get an update on, again, the FinTech Charter and the OCC. And I am delighted to welcome him to the podium. Mr. Noreika.
All right, well, thank you, Chris. I appreciate that very much, the warm introduction. This may be the least controversial thing I do today, so happy to enjoy it while it lasts. It's my pleasure to be with you at the Georgetown Institute of International Economic Law's FinTech Week. I'm honored to participate on an agenda with so many authorities in the field of banking and financial technology, both domestic and international. It's also comforting to see so many familiar faces who have over the years shared my passion for banking, finance, and the law. I enjoy taking advantage of these opportunities, particularly at venues like this one, that welcome provocative thoughts and embrace frank dialogue on important topics that may challenge one's long-held assumptions and beliefs. I congratulate Dean Traynor and his team for hosting such a remarkable event and look forward to being a feature on the annual Washington calendar for many years to come. My favorite part of these events is hearing from you, and with that in mind, I plan to keep my remarks like my tenure as acting comptroller brief so that I leave plenty of time for the questions that come afterwards. That last part was a pun, too. Before providing an update on the good work of our Office of Innovation and the latest on our thinking regarding a charter for fintech companies that offer banking products and services, I want to share my optimism about banks, fintech companies, and the business of banking as a whole. I think we're at the beginning of a period in this country that is more open to rethinking our approach to regulation so that we can promote economic opportunity while ensuring the financial system operates in a safe and sound manner and protects consumers from abuse. Bankers, industry members, regulators, and legislators appear ready and willing to have discussions today that would have been impossible 6 months or even a year ago. And that change in tone is very encouraging and suggests we are finally able to have a constructive, bipartisan conversation about how to approach our regulatory framework. The Treasury's core financial principles released in June lay out many opportunities and a direction that is helpful in any conversation about rebalancing regulation and promoting economic opportunity. In anything we consider, we must carefully weigh the cumulative effects of our actions. That includes the impacts on markets, consumers, and banks, and on other companies, such as fintechs that are innovating the way financial products and services are delivered based on the evolving needs of consumers, businesses, and communities nationwide. Another reason for my optimism is that I view change, including the significant shift occurring in the financial services marketplace today, as the natural evolution of banking itself. The federal banking system and the state banking system have been laboratories for innovation and technology for more than 150 years. Replacing state banknotes with a single national currency was revolutionary when President Lincoln and Secretary Chase conceptualized the national banking system during the Civil War. The checking account and later the credit card were giant leaps forward that empowered consumers and businesses and helped to fuel commerce. Some in the room will even remember a time before ATMs became ubiquitous and gave us access to and control over our bank accounts 24 hours a day. And mobile banking is accelerating the speed of money and expanding control to your smartphone. While any one of these events seemed like a revolution at the time, together they demonstrate financial services evolution toward increasing convenience, speed, and control. Cumulatively, we call that progress. I don't think anyone here wants to return to the days of the traveler's checks and wondering whether the store down the street accepts your particular bank card. Still, in each case, the change met resistance, faced operational challenges, and required regulators to revisit older ways of thinking about risks and the regulation of the business of banking. The same process is occurring today, but what has allowed the business of banking to evolve so successfully is that we have remained open to change and created a framework of laws and regulation over time that allows banking activities to evolve. That is why we have to be careful to avoid defining banking too narrowly or in a stagnant way that prevents the system from taking advantage of responsible advances in technology and commerce. If we take a stagnant view that blindly defends the status quo, the world will pass us by and we will become a footnote to history. 40 years ago, the Ninth Circuit recognized this situation and in its wisdom wrote, quote, "Whatever the scope of such powers may be, we believe the powers of national banks must be construed so as to permit the use of new ways of conducting the very old business of banking." That wisdom reflects the same spirit behind the work of the OCC's Office of Innovation and our efforts related to special purpose national bank charters. It has been just more than 10 months since Comptroller Curry appeared here at Georgetown Law and discussed this topic. I am sure he shares my pride in the work of our Chief Innovation Officer, Beth Knickerbocker, and her team in the ongoing discussions regarding the proper ways that fintech companies can participate in the banking system. The Office of Innovation began operating in earnest in January. Its primary purpose is to make certain that institutions with federal charters have a regulatory framework that is receptive to responsible innovation and the supervision needed to support it. Part of that mission is to assist banks and non-banks alike with understanding our expectations regarding safe and sound operations, providing fair access, and treating customers fairly. The office serves as a clearinghouse for innovation-related matters and a central point of contact for OCC staff, banks, non-bank companies, and other industry stakeholders. Within our agency, the office has worked to raise awareness and understanding of industry trends and issues. We want to make sure that our staff understands the latest industry developments, such as the use of artificial intelligence and machine learning, the latest payment developments, and the evolution of lending, as well as bank fintech partnerships. This familiarity will allow staff, particularly examiners, to have meaningful and helpful conversations with the banks we regulate. The office also collaborates on innovation issues with OCC business lines and other regulators and facilitates related activities. Externally, the office has published guides and reference materials for community banks, as well as financial technology companies and non-bank institutions. A large part of its activities involves outreach to establish a more open and continuous dialogue regarding innovation. I credit this outreach with helping to change the agency's attitude toward innovation and the tenor of the industry conversation. A big part of this outreach includes hosting so-called office hours. And so far, the office has held office hours in San Francisco and New York and plans to hold others in hubs of significant financial innovation. During these meetings, team members explore potential innovations, discuss how companies can work with banks, and talk with more than a few companies interested in becoming banks. These meetings also allow the agency to share its perspective early in the innovation development process. And now the office has innovation officers in DC and San Francisco, and soon will add an officer in New York in November. The office has already become a valuable resource for national banks and federal thrifts, and will, with this additional staff, its utility will only increase over time. Another way the office is supporting innovation is by developing a framework for OCC participation in bank-run pilots that allow banks to develop and test products in a controlled environment. We're still in the early phases of thinking through these issues, but believe pilots can be a useful tool for the agency and the industry. Pilots can accomplish the same goals as what others call sandboxes and allow us to gain insight into a product and to become comfortable with the proposed product's controls and risks early in the process. The idea behind our effort is to create principles that support the industry's need for a place to experiment while furthering the OCC's understanding of innovative products, services, and technologies. Information gathered in the pilots can inform OCC policies and help make sure that we are ready to supervise the new activity when rolled out on a larger scale. Again, we are still in the early stages of developing our approach and will have more to share as we progress. While I think the work of our Office of Innovation is having a positive effect supporting responsible innovation in the industry, our continued deliberation of whether to offer national bank charters to fintech companies seems to get all of the attention. With so much interest, I think it's important for me to update you on where we are in that process and to correct some misperceptions that I see out there. In July, I shared my views that companies that offer banking products and services should be regulated in the same way that banks are and subject to the same type of ongoing supervision and examinations that banks face. Anything less creates an uneven playing field that is unfair for banks and potentially unsafe for their consumers. I also shared my view consistent with my predecessor that companies that offer banking products and services should be allowed to apply for national bank charters so that they can pursue their businesses on a national scale if they choose and if they meet the criteria and standards for doing so. Providing a path for these companies to become national banks is pro-growth, can reduce regulatory burden for these companies, and can bring enhanced services to millions of people served by the federal banking system. National charters, however, will never be compulsory and should just be one choice for companies interested in banking. That option can exist alongside other choices that include becoming a state bank or a state industrial loan company or operating as a state-licensed financial services provider. States like Georgia already offer limited purpose charters that even allow commercial companies to be the parent of that state institution. A fintech company also has the option to pursue partnerships or business combinations with existing banks, or could even consider buying a bank if that makes sense. If, and it's still an if, a fintech company has ambitions to engage in business on a national scale and meets the criteria for doing so, it should be free to seek a national bank charter. That includes pursuing a charter under the agency's authority to charter special purpose national banks or the agency's long existing authority to charter full-service national banks and federal savings associations, as well as other long-established limited-purpose banks such as trust banks, bankers banks, and other so-called SEBA credit card banks. Many fintech and online lending business models fit well into these categories of national bank charters, and there has been some interest in fintechs becoming full-service banks, trust banks, and credit card banks. Chartering innovative de novo institutions through these existing authorities enhances the federal banking system, increases choice, promotes economic opportunity, and it can improve services to consumers, businesses, and communities. As for our initiative to use our authority to charter non-depository fintech companies, that remains a work in progress. And as you know, that authority is being challenged by the Conference of State Bank Supervisors and the New York Department of Financial Services. Although we will defend that authority vigorously, we have not yet decided whether we will exercise that specific authority. Before we make that decision, we need to be certain that the companies expressing an interest in becoming a national bank fully understand just what it means to be a bank. Many startup companies' business models are intended to be an experiment that may only last a few years. After that, if the product or service doesn't go viral, no harm done. They will try again with another new idea later. That's fine for startup companies and healthy for the economy, but that just doesn't really work for banks. A national bank charter is a special thing, and the OCC will not undermine its value by granting charters to companies that are not ready to meet our admittedly high expectations. I also want to address a concern that I think has been exaggerated with the intent of scuttling our idea for a fintech charter. And that is the argument that a fintech charter may be a slippery slope toward the inappropriate mixing of banking and commerce. People who make this argument suggest that such a mixing would result in destabilizing the market and increasing consumer abuses. That idea has been blown out of proportion in my view. I merely suggested that we should talk to any company interested in becoming a bank and that commercial companies should not be prohibited from applying if they meet the criteria for doing so. Talking about and applying for are obviously a long way from approval of an application and even further away from resulting in the kind of harm and abuse suggested. First, every application would be considered on its own merits. Is the business plan sound? Does the proposed management team pass muster? Does the proposed company have adequate capital and liquidity? And are its processes adequate for ensuring that it operates in a safe and sound manner, provides fair access, and treats customers fairly? Does it have a good chance to succeed? Then, if the company receives a charter, it will be subject to regular examination and ongoing supervision by what I think is the greatest team of bank supervisors in the business to ensure that it stays on track. Second, there are already dozens of examples where commercial companies are allowed to own banks at the state and federal level without such abuse and harm. National credit card banks, state merchant processing banks, state-chartered ILCs. The law allows commercial companies today to own these type of banks for good reason. They support legitimate business goals and deliver valued products and services to their customers. The Bank Holding Company Act defines what it means to be a bank for purposes of that act. If the chartered bank does not meet that definition, its parent would not become a bank holding company solely by virtue of owning the bank, and therefore, non-bank holding companies, commercial entities, or other banks could own such banks under the law. But we should be crystal clear. The chartered entity regulated by the OCC would be a national bank engaged in at least one of the core activities of banking, taking deposits, or paying checks, or making loans. The folks who suggest that the OCC is considering granting charters to non-financial companies are wrong, and the more sophisticated ones know it. We should not let fear prevent a constructive discussion of where commerce and banking coexist successfully today and where else it may make sense in the future. I think this is a topic that deserves a lot more exploration. I want to close by reemphasizing my optimism about banking and the financial services industry. Innovation and technology are making products and services better and business operations more efficient. The market domestically and internationally has plenty of room to grow, and today in Washington there's real energy around reducing unnecessary regulatory burden and promoting economic opportunity. These are good reasons to be optimistic. So again, thank you for having me, and I'll be happy to take your questions. So.
Georgetown, and this is yet another occasion where the leaders of the OCC have not been shy about sharing their opinion and stirring the pot a little bit. But I think before I get to some of the more interesting ideas, I want to just ask a couple of sort of basic questions I think are useful for lots of folks and other regulators from other regulatory agencies who are considering emulating certain aspects of the path taken by the OCC. When you talk about a pilot project, the OCC is a little bit different as a banking regulator as compared to a derivatives regulator or a securities regulator and the like, also in terms of its resources. But how resource intensive have you found your pilot projects to be? Do you think that when you move into a sector like fintech, are there certain kinds of vectors to those projects that are more cumbersome or more difficult than traditional pilots that have been undertaken before in the past? And how likely and effective are pilots? How quickly and how many pilots really can you expect a regulatory agency to be able to leverage given the pace of innovation and just the wide spectrum of products that are now coming to market?
Well, great question. I was going to joke something like I've never been asked this one before, but I have. So first, I have to say, as far as our agency goes, we're kind of at the very beginning stages. I know that Comptroller Curry had sort of strong views on both sides of a type of sandbox approach. I may take a little bit different view of that in the sense of a much more sort of encouraging, and I think there needs, to me, the value of a pilot from what I hear from people like you is, we have a very complex regulatory sphere in trying to develop a product or service may never get off the ground because it's hard to comply with this regulatory maze. And so you're a startup company, it's bad enough to have to deal with one regulator. You have a bunch of overlapping regulators with consumer protection, safety and soundness, other types of compliance, BSA, AML. And I think we're sort of at the very early stages, again, because I'm just on the job for a few months now, of trying to set up a pilot program of how it would work. And again, using our Office of Innovation, which is not only helping the agency understand about innovation, but helping the industry understand about our space, our regulated space. And so I think the way I would, first, given our regulatory landscape, there's only so much a pilot can do. Like, I can only, absent an act of Congress or agreement from other regulators, only grant so much potential legal insulation from potential liability because I don't enforce the consumer protection laws. I don't write the anti-money laundering laws or rules. So those are some limitations. And so I think what our challenge is at the OCC, even before we get to the amount and volume that we can handle, is developing the right structure under which we can help foster innovation, learn about how to supervise innovation, while taking into account these type of considerations that would prevent that type of pilot program from even taking place. So I know in other countries like the UK, there is, with one financial regulator, you can do this very easily. Now, I think there are some pros and cons to that. In my own view, our regulatory framework here in the United States is quite good for innovation because it each regulator, almost like the separation of powers of the U.S. government or federalism, their jurisdiction is limited. So it does allow people the freedom to work under different regulatory regimes that encourages innovation. Unfortunately, the downside of that is sometimes those regulatory regimes overlap, and it's hard to grant the insulation absent some type of act of Congress to be able to do that. Whereas in the UK, it may be easier to create the space, but once you go out of the space, a lot more one-size-fits-all regulation may apply absent the ability of the innovator to convince the regulator to change those rules. So,
and tomorrow we're actually going to have Chris Woolard coming through from the FCA to talk a little bit about those differences in terms of mandates and regulatory approaches. But from your perspective here in the United States, does this mean, well, I guess specifically when moving to the fintech charters, you can ask how much coordination has there been with other banking regulators, including the FDIC, but even a year ago or so when Mr. Curry was here, there were actually a number of folks from the market regulators who were curious and interested about how things would play forward and play out as to the coordination and the interagency coordination between the market regulators and the banking regulators where you do have that overlap. Is that coordination, do you envision it as playing itself out more from the Office of Innovation perspective, or is it more through the execution of the pilot, or do you think that once you get the data, that much of that interagency coordination would occur in the rule writing process?
So a couple ways to answer that question. First, I think there's already in place a lot of infrastructure for the agencies to coordinate with themselves, and so a lot like what I was talking about in my prepared remarks about doing new things in old ways. I think that's probably the fastest and best and most optimal way to run these issues through the various agencies. But I can also say at the principal level, everyone is extremely focused on this, especially the market regulators, Chairman Clayton, Chairman Giancarlo. They know, and I've heard Jay Clayton say over and again, the market is evolving. We don't have the option not to change in the way we regulate, and he's right about that. So I think that there's a tremendous sort of acknowledgement of it. Obviously, we regulate different parts of the market, so what I would resist, I've seen a lot of, interagency coordination works well, I think, when the agencies kind of do their own thing and share among and coordinate to the best possible. It works the least well when we all wait to try to get agreement and do it all the same way, because that, is basically you're bound by the least common denominator, and different agencies have different priorities and different views on things. And so, I think, again, as far as the bank regulators go, Comptroller Curry positioned the agency extremely well. He had a great understanding, again, knowing the history of the National Banking Act, which really, from its beginning in the Civil War, was an innovation. And that innovation has continued throughout the year. And what we're seeing is that the pace of innovation is just, the amount of market disruption is exponentially increasing now. So that's the one new thing, is trying to keep up. But the nature of the business of banking changing and evolving, I think, is sort of inherent to what the OCC's always been doing. And there are many Supreme Court cases, as you talked about having, I've been there, done that, and that's certainly something the unanimous Supreme Courts have recognized for the past 150 years of that dynamic, changing nature of the business of banking. I think some of the other bank regulators, they have to balance. We're fortunate in the sense of we have one mission: we charter and supervise institutions. The other two bank regulators do have other missions too. They have to, ensure the deposits of the, all the deposits in all the FDIC insured banks, and then, run the money supply. And those do compete for attention, I think. And so I think we're just sort of happy with our role, and certainly, I do interface well with the other banking agencies. I sit on the FDIC board. The FDIC has an Office of Innovation. Federal Reserve clearly is very active in this space, and that's good as well. So I think, again, it's one of those things, even on the regulatory side, having a diversity of views encourages innovation among regulators.
Well, as you mentioned, part of that innovation involves the innovation in terms of licensing, and obviously the FinTech Charter, which is of enormous interest for most of the people here in the audience. There have been quite a number of developments, in particular I don't want to say the rebirth of the ILC, but certainly interest in the ILC and questions that have, I'm sure you've heard, as to the comparative advantages and disadvantages of fintech charters as compared to ILCs, and you're seeing already that some tech companies, in particular Square, moving into that space. Do you have, certainly there's a mix and match of different kinds of options for tech companies, but could you provide maybe a couple of thoughts as to what are the relative advantages and disadvantages, and what kinds of considerations a fintech company could be taking into consideration when trying to decide which of those two may be most appropriate?
Well, sure. Look, I mean, they can all go consult with their counsel. There are a lot of good bank regulatory lawyers here. I used to be one myself. I mean, I wouldn't want to, comment on anyone's particular application, but there's a lot of choice in the marketplace, as you note. Obviously, you can have full-service banks at the state and national level. Industrial loan companies, a special type of charter, are only available at the state level. That allows the advantage of both taking insured deposits and not having to become a bank holding company under the Bank Holding Company Act and being subject to the restrictions that come from that law on affiliations. A fintech charter may or may not be a bank under the Bank Holding Company Act. National bank, obviously, has the benefits of being able to conduct your business with one set of rules on a nationwide basis, and has sort of a nationally recognized supervisor, especially for international companies that can interface with home country regulators fairly seamlessly. But that's the beauty of our marketplace. It allows individual market actors to choose these different type of charters that serve them best, and then it allows them to change that, if it doesn't make sense at some point in the future.
Okay, so good. So I guess I'll move now to some of the more provocative and thoughtful comments. And I'll just jump head first into, we're in a law school. You can think of hypothetical situations. You had introduced very interesting thoughts as to this question of commerce and banking, and I think that there's maybe a third vector that's entering into sort of the thought and commentary making community, which is data. So if you were to have, and a lot of the examples that you had mentioned over at the state level, you can't help but just sort of go to a more extreme cases. If a Google decided to apply for a fintech charter, would there be, in your view, any limitation on Google's ability to do so? And then feel free to elaborate as to whether or not you think it's even, or I should say, the risks, the rewards, and the trade-offs as to having a large tech company, which is really a data company, entering into the finance space through the vehicle of a fintech charter.
Well, first, let me just say, I'm not going to go into any particular, we're not going to answer any questions about, specific named companies, potentially exploring charters or not. That's not my place to opine on that, and, it wouldn't be proper in any event. But, look, where I thought you were going with your question, I mean, data and banks, have been going back for a long time. As I was telling some of you before, outside my office, I have a big picture of Jim Saxon, who was a comptroller in the 60s. He's really the first modern controller who recognized that the business of banking needed to change from, ledgers to, more data intensive activities. There are a number of lawsuits, perhaps also, akin to what you were just talking about, hypotheticals and controversial topics.
Next time I'll call
where
it a new company called Poogle.
Yeah, well, exactly. Well, so Jim Saxon got sued a lot, and we call them the Adapso cases or the like, where banks would get into data processing, and that was viewed as an inappropriate mixing of banking and commerce. Now, today, we wouldn't think anything of it that data processing is sort of the heart of what a bank means. And so, look, I think any type of hypothetical situation where a large commercial company would come in and want to own a bank, I think will be politically controversial. Now, my, own instinct of reaction is you have to, the law allows that person to come in and get a fair hearing. And, really, you take this back to Walmart or whatever. My problem with the Walmart case was not the yes or the no, was the absence of the yes or the no, where they, it seemed like, at least from the outside, I wasn't on the FDIC board, I know nothing about what was going on, but someone files an application, now you got to give them a yes or a no. You can't just string them along forever until they abandon their plans because you politically don't like it. I mean, they have a legal right to pursue this. And it seemed almost, what annoyed me the most or disturbed me was that it seemed like it was intentionally done to avoid judicial scrutiny under the APA, right? So if you don't give a final agency action, you can't go to court. And so, if the FDIC wanted to reject it, they should have rejected it. And they, but, did they not feel confident that they had the reason to reject it? So that, I think, is the biggest part. I realize this is a big political issue. I think it has to be discussed. I actually, want to foster the discussion because for me in law school, one of the most interesting discussions of whenever we discuss this topic, I went to Wharton undergrad, I did this type of banking. Everyone said I was kind of crazy because that's not the real type of banking, but then it became the real type of banking. And then I went to law school and I did the same thing. That was always the most interesting topic. Now, I don't necessarily have firm views because I'm open to persuasion, but I thought it was a topic incredibly amenable to here are the pros, here are the cons, let people make up their own minds. And clearly throughout the history of this country, banking and commerce have been mixed. And so we're getting to something newly controversial, a large data company maybe owning, but at one point, Walmart owning was controversial. GE Capital, GE, half of its business was a financial institution, and it clearly is a commercial company. And when you look back, the separation of banking and commerce in this country really was the result. It's not necessarily the most noble of stories. Unlike national currency to fund a civil war, the Bank Holding Company Act came because people wanted to put Giannini out of business because he owned too many banks. And so the original Bank Holding Company Act of 1956 only dealt with multiple bank, a company that owned multiple banks. So if you only own one bank, you were allowed to keep that bank and mix commerce. And it wasn't until 1970 that they closed that, and then it wasn't until 1999 that they didn't allow a commercial company to own only one thrift. And we still have some grandfathered institutions of that, as well as the other commercial entities, trust companies, ILCs. So I think we have to sort of get back and say we're looking at this at a point in time. The world is, we just finished the past administration. A lot of the bank appointees really, had this fervent belief in a separation of banking and commerce. But why was it? And what I was perceiving it is it was just like, it's because they learned that from the people who taught them, but they didn't actually think about it and qualitatively discuss it. And to me, look, I think there's a large competitive element associated with it. I get that, but do we really want to create an oligopoly or a monopoly? And that's not great for consumers.
So, it's such an interesting question. I had the pleasure of interviewing PayPal CEO Dan Schulman last week, and he was discussing at one point in time the acquisition of Whole Foods, and he said it was in hyperbolic fashion, but was fantastically delivered. When Amazon sort of swooped in, it was like the bombing of Pearl Harbor. He said, that the distinction in effect between your on and offline companies was quickly being eroded, as were the distinctions between digital and bricks and mortar businesses. And it seems to me, and so what he was mentioning was sort of a need, and this he was making an argument for a regulatory sandbox, and he was saying, well, what you really need to do is think of what kinds of innovations are needed for the new entrants, because new entrants into even now bricks and mortar businesses could find themselves potentially facing higher barriers to entry because of their lack of access to certain kind of data analytical tools to allow them to compete on equal measure with the, sort of the larger players. And I thought that was just an interesting idea. And just as I listen, right, there's always a set of choices that the OCC is making. On the one hand, by enabling fintech charters, you have the potential of increasing the amount of competition along and across a certain value chain of financial services providers, whereas at the same time, depending on who's applying and who comes knocking at the door and what subsequent regulatory measures then come attached, or strings or no strings, whether or not you end up sort of enabling competition in one way, but maybe at the same time enabling other kinds of oligopolies in others or not. To what extent could you foresee in the decision-making process where the competition concerns start to rise? Obviously, you want to make sure that you have a sound and safe banking system, prudential, safe banking, consumer protection. But at what point do you foresee now, with particularly tech firms, potential or other firms, more of these competition concerns?
Well, again, again, being a lawyer in this space, they always are considered in all of these decisions. It's something that's inherently been there, and that will be of great scrutiny. I mean, I guess a lot of people get worried about this, but from where I sit, I don't see a lot of the large players interested in these type of charters. I see a lot of smaller people interested in the charters, and maybe it's just a different perspective or asymmetric information, but that's sort of where we get our thought. We see a lot of smaller players, more of the community fintech, type business model who are interested, and that's really one of the reasons why we want to get to know them and their business model, get to know the industry, but also educate people through the office about what it means to be a bank, because again, the people who are interested, it seems to us, are on the smaller side, but and maybe people are thinking about it and not talking to us, or it doesn't get to my level, which is fine. But that's. But I think certainly any type of large entity who wanted to buy a bank, even if it were a large bank that wanted to buy another bank, clearly that would be covered. I don't know why it wouldn't be a topic of incredible scrutiny and interest if a large company wanted to get into the banking sphere. In fact, I think that would be maybe one of the main things that would be looked at.
Excellent. I'll just begin to open it up to folks in the audience to also suggest that you use the microphones just so that others can hear. But I will ask one question while you make it to the microphone. I know Teresa's jumping in. And when you talk about, particularly for fintech companies and the expansion of existing banking supervision rules, there was at one point in time, and I don't know if it's been cleared up entirely, but there's a little bit of a debate and concern, and I think it's worth either reiterating or stating, which was the Community Reinvestment Act and the application and the extension of the Community Reinvestment Act to those fintech charters, particularly as you move into the special purpose charters. What is the OCC's viewpoint on that, and has it evolved since Mr. Curry's comment that it is still in effect and would apply to all the fintech charters?
Yeah, so I think, look, the Community Reinvestment Act by its terms applies only to insured depository institutions. Clearly, any fintech company that became an insured depository institution would be subject to the CRA's requirements. In the draft framework that Comptroller Curry adopted, there was a financial inclusion type obligation that could or could not be applied depending on the nature of the institution. I think we want to be careful. One of the criticisms of that was it could be more prescriptive than the CRA itself, in the sense of if it became a condition to approval of an application, that's an enforceable condition through our enforcement authority. CRA is not enforceable through our enforcement authority. It's only, it's only a factor to be reviewed during certain types of transactions. So that's just the nature of the way the CRA works. And so I think we're certainly open to having a financial inclusion requirement. I think our challenge for the non-insured institutions would be how it would be applied, so to make it equivalent to the type of CRA. But it'd have to be, we'd have to think about it, because not all uninsured institutions are subject to CRA even now, such as uninsured trust banks and the like. So we'd have to, it would have to be a type of, specific to the institution of what made sense.
But for whatever sorts, we had yesterday in our peer-to-peer panel, we had general counsels from OnDeck, SoFi, Cabbage, and others. And I think, I don't know if any, or to the extent to which some of these folks, or their affiliates in particular, come through your door. They have some really interesting numbers in those regards, because I think they've been able to lever technology in very helpful and very cost-efficient ways.
Sure. All right.
Oh, sorry. I'm sorry.
Yeah.
He doesn't have a microphone, but he's standing there.
Oh, he has one. He has one.
I got it.
Oh, there he is. Okay.
Got it.
Looking at the wrong place.
Thank you for being here. Fabrice Coles with the CBC. We definitely applaud the OCC's continued progress towards the thinking about the charter, and we certainly applauded the financial inclusion plan. So to Professor Brummer stole a bit of my fire here, but just to push you a little bit more on this.
Sure.
Especially in light of last week's, I would call it kind of potential for regulatory relief around the CRA downgrades. Very curious about what the thinking in the building is in terms of supervision and reviews and enforcement authority for financial inclusion plans. I think that one of the critiques around CRA for depositories in recent years has been there's insufficient teeth. And so, I think that we care deeply about financial inclusion plans in light of the fact that this is clearly where the industry is going, especially for lending. We're just curious, what is the thinking in the building in terms of the use of supervisory tools and enforcement tools to provide teeth for a potential financial inclusion plan? Thank you.
Sure. Well, I think first we're getting a little ahead of ourselves because we haven't actually decided we're going to grant one of these charters. So that's sort of a gating item. I think if we get there, we have to finalize our framework, and financial inclusion will obviously be a part of that. But again, I think I think it's up to Congress to decide how we should apply the CRA. At the moment, CRA is applied not through supervisory actions. And what I would want to be careful about is there's a notion of if you're going to be a bank, you should be a bank subject to the bank rules. It's I think hard to justify applying a stricter standard to a fintech company or a non-depository fintech charter than is applied to a fintech charter. I mean, there's legal exposure to the OCC about applying a law that wouldn't otherwise apply to them. So I think our goal is to educate these charters about the value of financial inclusion and what they would, and to sort of get their buy-in, really, that this is a good thing, that they should have a commitment and live up to their commitment. And then I think, again, we're very far away from granting one of these charters, but then we have to see how it makes sense as far as an agency of how to enforce those obligations or how they live up to their standards, but in a way that's fair to their competitors.
Brian?
So Brian Knight, Senior Research Fellow at the Mercatus Center, George Mason. First, thank you for pronouncing the P in comptroller. You settled a bet between me and my wife.
Okay, there you go.
But second, so the...
Who knows if that's right?
I did. So the CSBS NYDFS lawsuit hinges on the question of whether or not a bank can be a non-depository. And so I wanted to get your reaction, either in your professional or personal capacity, to the argument that the states don't make unless you press them, which is it's unfair because states are limited as to what their non-depositories can do, right? The FDIA grants interest rate export to insured depository institutions, and the state licensed lenders or money transmitters have to go state by state by state. So what would be your view of, say, Congress amending the law to grant states more capability to charter non-depository institutions that have some of that cross-state power, or to grant some sort of passporting regime to state licensed lenders and money transmitters, somewhat on par with the OCC's efforts?
Okay. Lot to unpack there. I think that first I can only opine on what the business of banking is under the National Bank Act. That I feel pretty confident about, and have spent many years laboring in those vineyards. And again, I feel pretty confident on the merits of our lawsuits in which we're the defendant of the state suing us, that the business of banking conducted by a national bank has to include the taking of deposits. In my own view, again, having looked at this, the business of banking, historically has only been one of those three activities, and that's actually Congress came up with that formulation in what it means to conduct the business of banking at a branch of a national bank. So it's not like the OCC just, figured this out and clicked its fingers and made it so. It's actually picking up on what Congress defined as the business of banking. So to me, you don't get much more reasonable than actually using Congress's formulation for the business of banking. So that's why I feel, whenever the courts and the litigants get to the merits of the action, it's hard to say it's unreasonable to use Congress's formulation for what a national bank's business of banking is. Secondly, as far as what the state institutions can or can't do, I'm certainly open to ideas. I mean, I understand why Congress did what it did in the FDI Act and the Homeowners Loan Act to grant the similar exportation of interest rate authority to state institutions, absolutely vitally necessary. And if those institutions feel that that's necessary for non-depository banks, non-FDIC insured banks, then I don't think we would have a problem with that. I think there are other issues as well. In my own experience, and a lot just has to do with the cumbersome nature of trying to charter something or get it licensed on a 50-state or more than 50-state basis. And obviously that's one of the benefits of the National Bank Charter. If the states want to get together and have a way to simplify that, I would be entirely supportive. I know they've tried to make progress there. That we have a healthy dual banking system, and I hope that it continues for many years. She's a lawyer, so we have to watch out.
Yeah,
she's not only a lawyer, she's a very good lawyer.
It was very emphatic, too. It's like,
I said I wouldn't ask a question, but it's really a comment, Keith. I'm Meg Tyre from Davis Polk, but I kind of want to make the comment as someone who teaches part-time at Harvard, and it's about the banking commerce distinction. And I think I really want to applaud and encourage what you're doing on starting this discussion, because it's very hard teaching this. In the class that I teach at Harvard on financial regulation, 1/3 of the students come from other countries, and from Europe and from Asia. And it's hard to explain to them, Walmart could not have an ILC, but Target can. We do not permit commercial companies to own banks, except that GE could own a bank. And banks, going over those old data processing cases that you referred to, Keith. So data processing isn't financial, but let me teach you all about fintech, which is the new thing. And you can just see the foreign students starting to scratch their heads. And we do have almost this religious fervor around banking and commerce, which we were taught by our elders, and we haven't re-examined for the new world. And so it may well be that we don't want grocery stores to own banks, except they do in the UK. And it may well be that if that happens, we need to have them cabined off with firewalls and intermediate holding companies. But somehow, and I realize I'm not asking a question.
That's okay.
Somehow we need to really deeply explore this question, because technology is really rewriting what is commerce and what is banking. So I really hope we can go deeply into this in a way that we haven't for a generation.
Yeah. Well, thanks. I mean, just some reaction to that. I mean, just your comment, Meg, makes me think, and I think for those foreign students, where I might go with that is just to point out that, banking and politics in the United States go way back, right? I mean, this is Alexander Hamilton and Thomas Jefferson. This is, where they had their falling out. And Andrew Jackson and the Second Bank of the United States, there was no national currency from the end of the Second Bank of the United States until my office came around. And we see it today. I mean, it's a very controversial topic. Dodd-Frank was a partisan bill. Now that, maybe, when you sort of look at the long term, it's a very highly charged fault line in American politics. Now, people like Meg and I, we were fortunate, that there was sort of more of bipartisan consensus. So when we grew up, maybe there was a more established status quo. It may have sort of been gravitating toward the, taking commerce out of banking. But it was always very bipartisan. Every 5 years, you'd have a banking bill. It would always be like, whatever it was, the name of the bill or whatever, came out, and it was both Democrats and Republicans sponsored it. And there was a notion of recalibration of a dynamic industry. So we've kind of, maybe gotten to the stage of, more back to the historical roots, and yet not the more of the norm of recognizing that banking presents systemic risk. That systemic risk has to be regulated through legislation and regulation, and we all have more of a consensus. And I guess my guess is, as the sort of pendulum has swung really far to, we must do all these things, as Meg said, with a religious fervor, you have to ask, like, wait a minute, why? And that, again, maybe is just sort of the pendulum swinging back a little bit more toward the center of doing what makes sense toward encouraging economic growth and reducing systemic risk to the financial system. So, all right, lots of questions.
Yes.
There's one over there.
I'm Zaid Masari. I am a partner of Meg's at Davis Polk.
Okay, wow, Davis Polk Brigade here.
Yes,
too.
exactly. So to me, this discussion is fascinating. As a lawyer, it's really interesting historically for academic purposes, but I fear, just listening to the conversation, that the sort of theory and the pace of change of regulation is too slow for fintechs, right? For people in this room that are starting financial technology companies and need certainty faster, right? They think on 3-month, 6-month, 1-year timeframes. And though I haven't been around as long as you and Meg, in my experience, soon means something very different for regulators. So I was hoping you could comment on.
There've probably been some regulatory applications around as long as you've been around.
Yes. Fair. Though you may be giving me a little too much credit on my age.
Well, even then.
Even then. So I was hoping you could comment a little on what you think the path forward is for fintech companies who are thinking about a fintech charter, who might be thinking about their other options, given their need for certainty relatively quickly.
Well, look, that is a difficult question to answer, especially sort of with the way it was phrased. I suppose I would look at these obstacles as opportunities. So, it may be not to people's disadvantage to have regulatory uncertainty, because it's within that uncertainty that innovation thrives, in my view. And what I worry about on my side, and having been in your seat, is that the more regulatory certainty, a lot of times that regulatory certainty is no, you can't do that. And having been there, done that, that's not a great message to have to tell your client if you're a lawyer or if you're an innovator, to just pack up your bags and go home, because they'll be trying to push the rock up the hill to say you can't do it. So there's an opportunity there. I think the nature of regulating a regulatory industry is usually the regulations come after, not before, and that's just, again, the nature. The innovation drives the marketplace, and the rules have to follow it. And there are errors, risks, all that type of stuff that come with that. Unfortunately, that's just the nature of exploration.
And it seems like Zai is asking a different kind of question from Meg, right? So Zai is asking a kind of process, sort of regulatory execution question, whereas Meg is tasking law schools across the United States to think very deeply about, what's the nature of, I would suggest not only banking, but also what's the nature of commerce as well, right? Because it's the two are, or at least traditionally, were distinct, and then what does technology do to those things? So we have a lot of homework.
Traditionally in your lifespan, maybe, but not traditionally.
Well,
the country,
yeah.
You're young.
Oh, well, yeah, but old at heart, old soul. Okay, any more, maybe one last question, if not,
Here
yes.
we go.
Okay.
Hi, Brian Koenig. I'm a reporter with Law 360. I was wondering about the length of your appointment. There's 130 days. We're obviously past that. Or are you counting it differently? Any idea how long you're sticking around?
Well, look, I don't think we're at 130 days. It depends on how you count, and I think the Office of Legal Counsel and the Office of Government Ethics count working days, and working days takes us way out into November, but it's not a limitation either. And look, I think the people who wrote that letter know that, and so I think you're stuck with me until they get around to doing their job and confirming my successor. So you should go ask them to do that, because I'd certainly like a vacation.
Okay, well, on the note of vacations, we will convene.
Exactly.
There's lunch outside, but let's thank our speaker today. It was a wonderful discussion.
All right, thank you very much. Okay.